Okay, so today we're going to talk about options, and there's a lot of different ways that you can trade options. When I first started using Think or Swim, whenever I went to talk to the people at Think or Swim, they would never talk about trading options directionally, and I think there are times where it definitely makes sense to trade directionally, and when volatility is low and premiums are low, it makes more sense to trade directionally. When volatility is very high, so just before earnings, if you're trading directionally, again, you're going to get a huge volatility crush, and so in situations like that, a lot of times it makes more sense to be selling premium. If you look at a typical graph for options, there's 5 different ways that a stock can move. It can move sideways, it can move slowly up, it can move fast up, it can move slowly down, or it can move fast down. Now, in 4 of those 5 situations, if you bought a call and we're looking to trade directionally, only one of those 5 is really going to be profitable. On the other hand, if you sell premium, 4 out of those 5 situations will be profitable if you're just selling a spread. Okay, so the only time you get hit if you're doing a spread is if it moves in the opposite direction to what you were doing with your spread and it's moving quickly. So anyway, Chris has a great new template that shows you exactly what we're talking about, the difference between implied and historical volatility. And I'm going to turn it over to Chris now, and he can elaborate on why I think his option template is going to help you to do well in these kinds of situations where you're trying to sell volatility or buy low volatility. Okay, so Chris, take it away.
Okay, thanks, George. Let me just share my screen. Let me know when you see it.
You see it now.
Okay, great. Yeah, so with the introduction of EdgeRater PRO 2020, I also sourced a stream of data to do with options, and it's basically an options database that is now included in the EdgeRater premium data. And whole data, you don't get the whole database because it's a it's extremely large database. But what we do at EdgeRater when the new data comes in later in the evening, we process that data and we develop some interesting pieces of information, data streams to do with the options. And the data streams that are currently being processed and coming out and are available within EdgeRater are implied volatility for various periods. So normally when people talk about implied volatility, for instance, the VIX, the VIX is an indication of the volatility in the S&P, in the SPX index, essentially. But it's a 30-day volatility window. So that's great when you're dealing with expirations to 30 days. It tells you exactly what the volatility is over that time. And volatility is a measure really of what traders expect price to do in the next 30 days, essentially. IV30 is an indicator, a symbol within EdgeRater that's associated with all of the symbols in the CBOE weeklies list. And it's essentially the VIX calculation for volatility on all of those stocks. So, so we have the 30-period implied volatility, but also have calculated the several others. There's a total of 12 implied volatility periods, ranging from a 3-period implied volatility all the way through to a 720 period, which is essentially 2 years. And that they're all calculated using real end-of-day options prices at various expirations that straddle those periods, and then interpolating down to the period that of interest in exactly the same way that the VIX is calculated. So it gives some really good information. You can extrapolate from implied volatility to generate an expected move, a plus or a minus, and that is also something
Chris, your sound just cut out.
Is now with testing, check. Can you hear me now? 1, 2, 1, 2. Can you see my video?
Can hear you now fine, yep.
Okay, and you can
see your screen still, yep.
Okay, great. Not sure if it went out for everybody online, but in the classroom it went out okay. Yeah, let me know if that happens again.
Yeah.
Okay, so I don't know how much you heard, but the first template that has been developed to do with this new options data stream, the implied volatility data stream, is called the options IV and HV ranks. So IV is your implied volatility, obviously, and HV is your historical volatility. And that is just a measure going back over a number of days and looking at the percentage price change over that period of time and deriving a volatility figure for volatility over that period. You can then compare your future implied volatility and your historical volatilities. That's an interesting thing to do, and we'll show you some of that in the template. I know Dave McMullen has been successful trading some stocks using the difference between those two. But let's first just show you where this template is. It's a template you will find under the new category called Options Analysis. It's currently the only template there. And as I said before, this data, the options data, is only for options that have weekly, it's only for stocks that have weekly options associated with them. And it's because we're dealing with weekly options, we can then generate 3 period, 7 period, 14 period, 21 period, and 30 period implied volatilities. You wouldn't be able to do that on stocks that don't have weekly options because you'll never get those lower expirations. You'll occasionally get them because the expirations will come up, but you won't get them continually. So that's why this is really good for stocks with weekly options. So having run this template, you'll find the report will appear here. It has a chart associated with it, which is a simple chart with Bollinger Bands. Bollinger Bands are also a means of showing you historical volatility. And has volume, and then the chart below is 2 indicators. Essentially, the implied volatility, which is your blue or purple line, and historical volatility, which is the red line. So yeah, so for example, in this case, when we're looking at Anheuser-Busch, you can see that historical volatility jumped suddenly when there was this big gap down. Obviously, the way that historical volatility is calculated, that's going to make a huge jump there. But you can also see what happened to implied volatility. So even though historical volatility jumps up, traders were not thinking that is necessarily, there was no spike here in implied volatility. So possibly that was an earnings really.
Audio cut out again.
Can you hear me now? Let me know when you can hear me.
Oh, there we go.
Yeah. Is it just in the classroom or is it online cutting out as well?
Online seems fine. It cuts out occasionally in the class.
Okay. Not sure. Yeah, I can't really do too much about that, but just let me know when it does, and I'll pause until it comes back.
Okay, sounds good.
Yep. Okay. So you can see, as I was saying here, you see the historical volatility jumped because of the gap down, but the implied did not jump higher at this point. So that's an interesting tell in terms of the expectation of traders at that point. People who are actually buying and selling options. This gives you an exact figure as to what they expect to happen in the next 30 days. And that would be called the expected move, which is also an indicator that's available, and I'll show you that a bit later. That's actually very interesting stuff, and that's some of the latest additions to the program that everybody should actually have on their system now. So let's just first go into this template. This report from the options implied volatility template will rank the implied volatility, and this only deals with the IV30 because at the time that this report was generated, or the time this template was created, the IV30 was the only implied volatility in the system. But now there are 12 other or 11 other implied volatilities as well, ranging from, as I say, from 3-day period up to 720-day period. And the way that the report is organized is by the rank of implied volatility. So the actual absolute implied volatility varies greatly from stock to stock. You may have a stock that that naturally has a lower implied volatility than another stock. For instance, Microsoft is going to have a lower implied volatility naturally than Netflix. And so you'll see that. But the important thing to know is where implied volatility is compared to where it has been over the last period and the period chosen in here is 1 year. So that's one of the periods. There's also a 6-month period, a 3-month period, and a 1-month period. So it's telling you where the ranking is of implied volatility compared to the last 1 year. Let's look at the 1-year column. If you have an IV rank of 0, it means that implied volatility is the lowest in that stock that it's been over the last 1 year. And if you look down the chart of Anheuser-Busch, you can see that the purple indicator is now at 0.17, so that's 17% implied volatility, and it hasn't been 0.17 in the last year. We can open up the chart a bit more, try and go back a whole year, and you can see it's now the lowest it's been in a year. So that means that the expected move in Anheuser-Busch is lower than it's been in a whole year. It also means that options are cheaper than they have been all year for the same, they're cheaper basically. You're not paying as much in premium for that option. So if you disagree with what the general implied volatility and expected move based off of implied volatility is going to be, if you have some better idea that using some technical analysis method or some other information, you think there's going to be a bigger move than the expected move, then you can benefit from buying options. And of course, then you have to decide whether you're going to buy in the money options or out of the money options. If it's going to be a quick move, as George was saying, you're expecting a slow and steady move, or it's going to stay the same level. You can then make decisions about whether you're going to be buying or selling options and what kinds of delta you're going to be buying or selling. So,
for example, when you look at the beginning of October there, you can see the implied volatility was quite high.
Yeah, so we go back here. Yeah, so delta. Sorry, so October.
To October, right, so it's there.
Yep.
So your implied volatility is very high. So again, it might make sense in situations like that to be selling premium.
Right. This would have come up with the actual number of 32%. You can see on the right-hand side, that's a 32% implied volatility. Mm-hmm. But if you ran the report on that date, it would have also told you the rank, which would have been actually pretty high for the year. If you look back, horizontal line from that level, it's only been higher than that in February and last December. So quite a high rank, and that would have appeared in here as a high ranked IV, which means there's a lot of the expected move at that point is quite high. Now, expected moves are an interesting topic. It doesn't mean, what it means is the premium that you're paying for your options implies a move of a certain magnitude. It doesn't mean that the stock's definitely going to make that number in 30 days' time. It doesn't mean it's going to be at a certain level in 30 days' time, obviously. That would be good to know. But it just means that according to the Black-Scholes model of options calculations, that there is it's a 1 standard deviation chance of being within the plus or the minus of the expected move. And 1 standard deviation is basically a 68.2%. So you take expected move and you basically say the options are saying that there's going to be 68% chance of price being at the upper end of the expected move sorry, at the upper expected move or the lower, it's between the upper and the lower expected move numbers. That's going to be easier to see if we look at, if we just change this chart over to the, there's a layout in the system now. You'll find under, if you go to the chart layouts and you go down to, let's see, there should be an options. Let's just try and find that. Options analysis. So down here. Okay. Now this is a little, it might look a little bit more complicated, this chart, but basically it's taking three, okay, so the areas below the main chart are showing you short-term, medium-term, and long-term implied volatilities. And you can see how they differ. The short-term set of implied volatilities are your 3, 7, 14, and 21 period implied volatilities. The medium-term implied volatilities are 30, 45, 60, and 90. And these are days, these are calendar days, not bars. When you're talking about historical volatility, you're looking at bars. 22 bars is equivalent to 30 days, pretty much. And then you've got your long-term implied volatilities, so 120, 100, 180, 360, and 720 is equivalent to almost 2 years implied volatility. So you can see that. And then there is the actual expected move levels. So this will give you a number, an actual real number of what price is expected to be at in the next 30 days. And right now, the options are pricing in an expectation of plus 3.9 or minus 3.72 in Anheuser-Busch. If you think that it's going to make a higher number than 3.9, if it's going to go up more than 3.9 or lower than 3.72, then buying options could actually work out nicely. If you think that the move is actually going to be contained in that range, then selling if you sold an iron condor, if you did an iron condor, then that could work out for you. This chart also, if you look at the top of the chart, you've got these blue lines. The blue lines are super interesting because they are the expected move, the 30 period. You can change that over here, but it's currently default set up to be a 30 period expected move, and it's shifted forward 30 days. So whenever you see price outside of these bands, it means that the expected move was exceeded, essentially. The 30 period expected move was exceeded in the stock. And then if I zoom out here a little bit, you can see that most of the time, well, not necessarily most of the time, actually in this stock, you actually have quite a high percentage of time that the expected move was exceeded, here on the upside and here on the downside. And I have another layout. This one isn't yet in the system, but this will show you the percentage of time that price is within the expected range. And right now, that percentage is 64% of the time over the last 1 year. 64% of the time, Anheuser-Busch has stayed in its expected range. And that's a lower, you would normally expect it to be 68.2. That's the number that the model is calculated on. But here, it's been outside of its expected move more often than was expected. So that's an interesting view to see. You can also, now there's this, if you look at the top of the chart, there is now a number in here that you can enter to show future bars. So it just expands the chart out on the right-hand side. And what that does is allows you to scroll over to the right, and it will draw a cone of the expected move, where price is expected to be in this stock based on the calculated volatilities of each of those periods, based on real options pricing for each of those periods. So that's all calculated, and then a cone is drawn to indicate what traders think based on option pricing of where price is going to be after a certain period of time. And this will be drawn out to up to 720 bars in the future. You can always take a look at this and get a feel for what the options are expecting.
Chris, can you go back in time and do the same analysis?
Sure. Yeah, I mean, absolutely. Actually, if you look at the blue line, this is a good way to go, is take a look at the blue line, and this has been shifted forward by 30 days. So what you'll find is if price is ever outside of the blue line, then expected move was exceeded. So you can just scroll back on the chart.
Would you be able to go back into 2010 and look at something like Baidu?
Oh, so the options data that we have only goes back 5 years.
5 years. Okay, so back to 2014. Yeah, because I think it'd be interesting to see what the options data did, and when Thinkorswim people were telling me that I've had about 7% of something working, and I thought it was more like 85%. So
right,
that's what you're looking for. You're looking for situations in which there's a high probability that it's going to move outside the range that the implied volatility is telling you, and that's where you have an edge in trading.
Right. Yeah, exactly, and that's what this is trying to show graphically with the what this is called the expected move cone, and then the blue lines are called the expected move levels, and that's the cone is based off of all of those various periods that I mentioned, but the levels are fixed at one future period, and in this case it's fixed at 30, but you can change it. You can't change it to a random number. You can't say you're looking for a 15 period here. Yeah, you can't say that, but you can say any one of the implied volatilities that we actually have data for. So we know we have data for the 45 days to expiration. So you can change that, and then these levels will be drawn and shifted the correct amount to make sure they superimpose with price to let you know if price exceeded that level. So if you take it to 360, which is almost a year, and you can see now
360 trading days or 360 days?
It's 360 days. So all of the options days that are in the program, in the indicators, are all actual calendar days.
Right. So they include holidays, weekends, whatever.
Yeah, and you'll find that's the way the options are quoted as well. If you look at the Thinkorswim platform, they'll say days to expiration will be 3 days. If it's a weekend and it expires on Monday, and you look at it on Friday, it will say 3 days. So that's a standard across the board, and it's kept in the program like that too. So the program automatically shifts these bars the correct number of days, so that the superimposition is correct, allowing you to see if price exceeded the expected move. So it's a super interesting view, and you can see here. Now we're looking at the 1-year expected move bands. Obviously, they're wider than the 30-day period, but price for Anheuser-Busch has actually stayed within the 1-year expected move bands pretty well. And then they had this period down here when it was outside of that area. And if I go back down to this indicator, the expected move versus actual percent, and change this to a 360 period, this will actually give me the real number, 69.84. If you look on the right-hand side, 69.84% of the time, price was inside the expected move bands. Now, the calculation of expected move, as I said, is a 1 standard deviation expectation, so it should normally be 68.2%. So it's pretty close to to the model of the Black-Scholes model in this case, which is very interesting. One interesting thing is if you're looking at the 1-year period, I found this to be a interesting stat. Is if we change the symbol over to be, let's take a look at SPY. Okay, so now I'm looking at the these bands are now 1 year in SPY. And if we go back a year to so we came from outside the upper expected move level, but that was over a year ago. So in the last year, from today, in the last year, price of SPY has been 100% contained within its 1 year expected move levels, which you might find surprising considering there was a 20% sell-off in leading up to December of last year, and then the amazing 30-odd% rally that we've had during this year. Prices of SPY has still stayed within those expected move levels.
But if you use the 30-day back on December 24th,
yeah, if we change this back to 30, we go back to December 24th over here. Let's just position the chart over to here. So this was December 24th. Price went outside of the expected move in the latter part of December, but only for a few days. Everything else was predicted by option pricing. Even it came out of the expectation for a period over here, but then option prices adjusted. As you can see, the implied volatility is going higher here, so options are being priced higher and higher. So they're expecting more of a move, which puts the bands at wider distances, and so eventually price does get contained within these expected move levels. And even in this rapid decline down to the capitulation down on December 24th, it was only 2 days when it came out of the bands below, and then obviously the recovery, it was still below. But since then, for the most part of this year, it has stayed pretty much. If you look at let's look at the number down here. Change this back to a 30 period, and we'll see the number is 73%. So SPY has been inside its 30 period expected move level 73% of the time this year, which is still higher than what would be expected by the model. So the option prices have been pumped up more than they should for what actually ended up happening with price. So that's a super interesting thing. So let's go back to the template. This is a little aside talking about expected move levels and the cone. You can see the cone over here. So that was a little aside, and that's just another layout that is brand new in the system as of about a week ago. So you can play around with that. This chart layout is not linked to this template. This template is actually linked to the simpler layout that I showed earlier. So if I go down through some of these stocks, go back down to the simpler Bollinger Bands and implied volatility versus historical volatility. So getting back to the template, that was just took that all expected move information as a extra information. We'll get back into the template now, and now I'll just go down through this list, and we'll just take a look at how why some of these stocks are appearing as low implied volatility. Also bear in mind what I said yesterday, in that you can run templates in conjunction. Once you've got a report on the screen, they're all linked together. So if you're looking at low implied volatilities in conjunction with another template, which might indicate to you a higher probability of a move, that would be great to have those side by side. One of those might be a seasonality template. You might have another. You might have looked at the in-play template, or the Mark Minervini template. You can put them all side by side, and then as you're scrolling down through this list, you'll find what those other reports are saying. So let's just do that for one of these templates. Anything you might want to look at there, George? We'll take a look at seasonality is always a good one.
Yeah.
So let's just run seasonality on this list of CBOE weeklies. And I'll just drag this so it appears below here. Okay, so now as I go down through this list from Bud down here, you can get an indication now that upcoming move in Bud over the last 10 years is basically a 50-50, a 0% average with a 5 and 5. And as I come down to the others, as you just scroll down through the list, the seasonality template will update to show if there's any good seasonal expectations. And this was a way that Dave McMullen was searching for some stocks. He had sent me a good trade that he made. One of the things he was looking for was a difference between the historical volatility and the implied volatility. He was looking for cases where historical volatility was a lot higher than implied volatility. And he found a couple of good trades. I think the one that he sent me was a trade in STMP. Let's see if we can bring that up. STMP. Stamps. No idea what they do, but yeah. So he had found this had come up on the template way back over here. I think it was that he was talking about. That would have been in August, where you can see the red historical volatility was much higher than the implied volatility. So he bought a call in STMP around about, somewhere around here, and he held on to it. And by the time he sent me the email,
Chris Tyler was talking about action candles today. So you have two potential viable gap ups with action candles on that chart.
Okay.
They both have those
right
doji type candles.
Okay. I did not hear that presentation. I am looking forward to hearing that on the replay. Yeah. And so you can use it in combination with other templates. We have a candle pattern template as well, where we've got things like the power bar. Sounds like we'll have to add in some action candles.
Your volume breakout template's very similar. It's not the same, but it's similar.
Right. Yeah. There's the Mark Minervini would be a good one to look at for low implied volatilities, but you've got stocks are moving. They're moving. They're highs and they're moving. Linear regression would be a good one if you're looking at the slope of the linear regression to continue. Then that gives you a great projection out to the future as to what price could be if it follows that line. But you also will know from here what the options are pricing in for that move as well. So when Dave sent me this, it was probably somewhere. I think it was before this big jump here. But in the options that he had chosen, he had made over 400% at that time. So he was quite happy. I'm not sure if he held it on for the remainder, but possibly. Anyway, so that's one thing you can do with the template. And if that, I don't know how many people modify templates, but it is actually straightforward and recommended to, if you have a specific thing you're looking for instance, in Dave's case, he was looking for the difference between historical volatility and implied volatility. That's really just a calculation that this template could very easily do. If you just modified the template and added a column, you would do that within Microsoft Excel, and you just say, hey, you just do the IV minus the HV, and then you can sort by that number, and that would just immediately give you a good list of stocks to look at that have implied volatilities or historical volatilities much higher than the implied volatility. Is that all making sense? Any questions?
It's going to take a lot of thought. Question, Chris, using best choice, VEEV comes up as a trade. It's been long until the end of the month, and then it's a short after that, like on a consistent basis, like, 10 out of, six and 0. For
Did you say
a 10% average move up?
Yeah.
The 14th and 28th of November, and then right
Yeah.
after November, I think the results come out, and it's short after that. Would that, how would we look at it on this graph? Or would you know, like, if I got a contender from some other scan?
Is it a weekly?
I don't know.
Yeah, I didn't see it when I scanned. Just did you say V for Victor? VEEV?
Yep.
Yeah, it's not in this list of weekly. It doesn't have a weekly options.
Okay.
But if you find something else, we could definitely take a look at it if it has weekly options.
How about W?
Just W?
Yeah, that's. How is that?
I've got X. There we go. W. Wayfair.
Yeah, that's Wayfair, W.
Yeah, okay. So I found W here. What this is saying is 9% average over the next 2 weeks. Only got 5 years of history. Does that make sense? Do you have that too?
Yeah, this has got 11.6% from the 17th to the 2nd of December.
Okay. Well, this is showing 9% from now for the next 2 weeks, and then after that goes down to 7%. So it's 7% for the next month, 13% for the next 2 months, and 23% for the next 3 months.
Okay, I don't have all that data, but just picking out a trade, this is very interesting with your implied volatility, because for each versus the historic, and I guess you can look at volatility rush when the price comes out. And I don't know how to interpret that through this, but I'm sure there's a way.
Yeah, well, one of the things is if you think if you take seasonality and you're saying 1 month, that's about 30 days, right? So we'll look at the IV30. Now this is saying that there's a potentially a 7% move if you take the average, 7% move. What is 7%? I'm going to make you do some calculations now. What's 7% of 84.71?
9.26.
Okay.
77. Try it again. What is it, Chris?
What's 7% of 84.71?
So 5880. Oh, 588. Sorry. 588.
588. Okay. So the seasonality is saying that there's a potential move of $5.88 in the up direction. But does the implied volatility indicate that as well? So what we would do in this case is look at the chart layout that I had on before. I'm going to go back over to my layouts, and I'm going to choose my expected move bands over here. Okay. Expected move based on current levels of implied volatility is plus 13.99. Okay. So that, I mean, that's just the number. So the options are pricing in that the price level of Wayfair is going to be within plus 14 plus $14 or minus $12. That's basically what the IV30 is giving you. So, but with your seasonality of 7%, that's not, that's all contained within the expected move. Right, so.
And I'm not sure when earnings are, if this was going into earnings,
yeah,
you would expect that they would be, the pricing would be big.
The implied volatility would be larger
Yeah.
coming into
And
earnings.
making the options more expensive.
Yeah, so if you look, take a look at the implied volatility charts below. Okay, you can see that implied volatility on the short terms has been rising, and it's now had a sudden drop off. So it sounds like earnings may have come out already potentially on, I would say probably Thursday evening, Wednesday after the market close, 10:30. Is that?
Actually, I just checked on Thinkorswim, and it's 11/3. I think it came out on November 3.
And that's where it locked.
That's it there. That's it. That back up. That's on the big drop there.
11/3. Oh, so it is here, right? Okay, so 10.
Next earnings is February 20th to 24th.
Okay, but it looks like the move and the implied volatility has dropped off actually before earnings came out. So some news was. Oh, so William says, missed that. Let me try and find the chat again. William is just saying that had earnings on 10/31 before the market opened. And if you look at the chart here, we're looking at 10/31 was when you had the drop. The implied volatilities of all periods were going higher until that day, and then after earnings were announced, implied volatilities as well as expected move dropped significantly.
Yeah.
Yeah.
So would those bars outside the blue channel say that if you had bought options earlier, you would have been in the money? Or am I reading that wrong?
It's essentially it's the right idea, and it would really depend on what kind of options, what kind of strategy you had. Obviously you can choose if you just bought a put, for instance. If you bought a put, you would definitely be in the money here. But if you bought a straddle, you would probably, if you bought the straddle right here and you sold the straddle down here after where the expected move, when it went below the expected move, you would probably make money too. It just came down below, right? Nothing really significant. So it was, at this point, it did exceed the expectations by, let's say, it went from the expectation for earnings, the 30 period, well, let's say the expectations for 30 days after the earnings were here. Price closed at 100.74. This is the day before earnings. Yeah.
If you bought your a put 2 days before, then you can see where the expectation was 2 days before, and it went quite a ways below that. So you're going to have a better return 2 days before if you bought your option then.
Right.
Yeah.
Chris, can you show a chart of Tesla?
Yeah. Okay. So here's Tesla. I know somebody had some good options in Tesla. Who would that have been?
Right. the one I made and then the one I missed.
Yeah. So George bought Tesla here after earnings, right?
Yeah, it was actually the next day.
The next day. So it would have been in here.
Yeah.
On this bar. So earnings were already out. Implied volatilities had already come lower. And then George was able to buy a low delta option here and make an incredible trade. Best trade of the year, I heard.
Well, the most profitable. I don't know. Evaluating best trades is something different than.
Right. So yeah, most profitable trade. Yeah, so at this point, just before earnings, so it did move outside of the expectation.
Right. So if you had bought some calls there or you'd done a bull put spread, you would have done very well in both situations there.
Yep. And then it did continue to move higher, and then on Friday it looks like it had some kind of drop, but it's now dropping back inside the 30 period expected move. So it's now back where if people were trading 30 days ago, had bought or made options trades, this is now where they expected it to. This is now where they expect price to be. It's actually exactly within the, exactly on the expected move line. So that's how you can read this. Traders are expecting price to end up here between the upper expected move line and the lower expected move line and price is at the upper expected move line. All of this stuff in here, outside of the expected move, this was unexpected.
So one of the things that I don't know if you can scan for it, but just finding unexpected moves after earnings, like that's what Tesla did, and that's why I was basically stalking it. But I mean, I watched Tesla pretty regular as well.
How does it do with like December last year? Tax law sellers.
So Brock's asking what happened with Tesla back in December of 2018. Chris, can you hear okay? We've lost your sound again. Chris?
I can hear your voice, George.
You can hear my voice? Can you hear Chris? Chris, we've lost your audio. I don't know if you can hear me.
Cursor's moving. He's talking, obviously. So.
Can you send him a message on just that we've lost audio
I sent him a chat on the screen.
in the chat? Okay, so you can hear me, but not Chris.
You can also take a look down at the expected move, actual level itself.
Chris, we lost your audio there for a minute.
Oh, sorry. Where did you?
Well, you were showing the chart of Tesla.
Oh, okay.
And then
Sorry.
cut out.
Okay. Is William? Are you online, William, or are you in the classroom?
William's online.
Okay, so he cut out as well. Okay, so everyone cut out. Sorry, and it's probably the internet here.
Yeah. So somebody asked about Tesla back in December last year when the tax loss season was on. So they're just wondering what it looked like back in December.
Okay, so we'll go back to December, Tesla.
Mm-hmm.
Yep, that's over here. So December 3rd to 30th. So it looks essentially like this. So it had from the middle of December to the end of December. There was a sell-off, but it was nothing outside of. It was all within the 30-day expected move. So it's all within expectations of where the options were priced. It's pretty much stayed within the expectations of.
Right. So again, if you're going to make money on options, you have to get a move outside the expected price because the price that's built in is already priced into the price of the option. So.
Yeah, I mean, you could definitely have made money if you just bought puts here. All right, you definitely made money.
Definitely could have made money, and you could have sold a spread that's up at the top part there.
Yeah.
Or down at the bottom part there.
Yeah.
So as long as you don't have something like earnings coming up that's going to have a big impact on it, you can sell premium at the outer boundaries of your expectations there.
Yeah.
So that's a way that you can make money using that chart, right?
Yep.
Can you look at a chart of Apple, Chris?
Sure. Oops. AAPL. Here we are, Apple. Let's move forward to today. Okay, here's Apple to today. It's pretty much stayed within the expected move, but over the last year, I've got this set to a 30 period. Yeah, over the last year, this is quite low. Apple has been 50%, only 50% inside its expected move over the last year. So it's been surprising then to the options have been underestimating the move.
Okay, and again, options don't take into account the trend strength. So if you're in a very strong trend, if your growth rate's very high, then that's where you can make money. And this is very similar to what was happening with Baidu. So it would start off inside Chris's anticipated where the implied volatility is, but then it would move outside. I'm sure it would have moved outside there on several occasions when I was trading in 2010.
Mm-hmm.
And that's what Apple's doing too. So the trend has been very strong, but again, the options model doesn't build trend strength or growth rate into the model. So it just looks more just volatility.
Right.
And that's where you could, so I'm sure you could have made money there buying calls on Apple.
Yeah, that would be interesting to look at right now on your best choice.
In terms of seasonality or what?
Not in terms of seasonality, but if it drops back down and you're still high implied volatility, then it makes sense to buy a call rather than stock.
Yeah. Well, again, Chris can probably look at. So you want to look at probably the linear regression chart. So yeah, so Chris could do the linear regression layout here and just show you where it would make sense.
Yeah, we're looking at the linear for
Apple.
For Apple.
Okay, and I can draw a linear regression line. Is that what you're looking at? Like this thing?
Yeah.
Sure.
Yeah. Yeah, so that would be saying, you know, the linear growth rate is 126%, exponential growth rate is 200% over that period.
Yeah, so again, you've got a very high growth rate there. You can see we have that green candle that went outside your linear regression channel. Again, it's looking at it in hindsight, but that was a good entry point for buying some calls.
Right. Yeah.
You have Roku as well. Could you take a look at Roku?
Yep. Let's go here, ROKU. Roku. There we go.
So again, you can see it's had periods where it's gone outside, and you can see after earnings in August there how it jumped up.
Yep, August right here. I spent quite a time outside of the expected 30-period expected move, and then came right through it and spent some time below the 30-period expected move. The percentage of time is 48% inside. The percent of the time inside your expected move has been 48%. That's quite low.
So it's actually good to find something that's below 50% of the time that it spends outside the expected move.
Well, yeah, I mean, it's not an indication of what it is going forward. It's just historically
what it's been in the past.
Yeah.
Mm-hmm.
So a little bit of help here, Chris, on that red candle high, the engulfing red candle high, yes. Where if you had bought option, if you saw that and said, hey,
I'm gonna buy
towards the end of the day, this is trend reversal.
Yeah.
And bought the puts.
Yeah, it's a good low risk entry to buy some puts.
And
your stop's going to be the top of that bar. So if it does keep, yeah, so you got a red bar, your stop would be the top of the red bar.
Okay.
So if it does reverse and negates that bar,
yeah, you're out.
Then you're out. Okay. So, and again, if it comes across into the channel there, then yeah, your puts are going to.
And crossing down below, can this give you an indication of exiting your?
Absolutely, I would be getting out once you went.
Yeah, because you've also got time decay in the puts. You're buying weekly, so you're not. I think on this, you're not looking too far forward anyway.
But again, you have that spell there where you go like 6 days or something where nothing much happens. It just you have a bunch of inside days
Yeah, right after the drop.
after the drop, yeah. So that's where you're losing time
Yeah.
premium there.
Yes.
Yep. And then William wants to look at Lulu. Lululemon. Now it's interesting to compare what the cone looks like. Compare Lulu to Roku. This is a much different looking cone. It's just because the different implied volatility numbers, you know, your IV3, 7, 14, etc., are just at different levels. They're not all separated by the same amount between Lulu and Roku. So you've got a much broader move expected.
7 to 14 days are imperative for retail.
So this one is at 83%. So Lulu has spent 83% of its time inside the 30-day expected move over the last year. So that's higher than you would normally expect it to be 68%. So it's higher, a greater amount of time inside its expected move.
Right.
And
So
partly that would be because earnings are coming out on 12/5 after market. So your implied volatility is broadening out going into earnings.
There you go. Yeah.
So
Yep.
Chris, can you look for stocks that spend a lot of their time outside your range?
No, not right now.
Okay, so it's not a column that you have there that you can sort through.
Not right now, no. Do you think that would be a useful sort?
Absolutely. I'd rather be trading things that are outside expectations than things that are meeting expectations.
Right. Yeah,
High
yeah.
degree of
Yeah, right. No, so all of these indications, the expected move indicators, they've all been put in very, very recently, within the last 10 days.
Mm-hmm.
This template was something that this has been around for a couple of months now, so haven't yet produced templates based on this new data.
Right.
But it is, who is that? Was that Gary talking over there?
Yes.
That was Gary, yeah.
Yeah. No, but that's an interesting point. You know, you're saying that 12.5 is earnings, and this expectation widens out to there, and it starts to go a lot slower.
Yeah,
That's
so
why
your implied volatility is going to increase just before earnings. Fire insurance gets more expensive.
Yeah, and you've currently got it says right here, 29. Right now, the 30-period move is plus 29 or minus 25. That's where options are, you know, the Black-Scholes model is indicating those are the levels. So 68% of the time, that's where it should end up, inside those two levels.
And your 68 is your 2 standard deviations.
That's your 1 standard deviation.
68. So 68% of the price stays within 1 standard deviation on either side.
68% of the time, price stays within 1 standard deviation. Yeah.
Okay. Cool.
Based on a normal distribution, but we all know that stock prices are not exactly normal. They have fat tails.
And your data is really good. Like I don't know if you heard, we had Pete Hoyt on here, one of our workshops. It was last year or the year before, but he talked about the bell curves for implied volatility and historical volatility, and how Best Choice was really good at finding where you had a disparity between implied and historical, and what the tendency usually is for implied to come back towards the mean. So implied will move towards historical rather than historical changing.
Mm-hmm.
So you get an edge when you can find the disparity there and where you think it's a high probability that the implied is going to come back. And so you can buy outside the implied volatility Chris was talking about the fat tails. So you're basically buying a fat tail there that gives you a high probability that something's going to happen. And that's what I was doing with Baidu. I mean, basically implied volatility, because the price was low in the channel. The implied volatility was very low outside the normal range that the historical volatility was in. And of course, when Baidu started to move up, my options, the calls that I bought, did really well.
Mm-hmm.
Well, the volatility would have been lower on Baidu when I bought them, and then it would increase because of the move. Right. So the volatility increases, the price of your option increases, and just the price of the stock, the underlying, has gone up, so the price of the option also goes up.
I find this one quite interesting on gold. You can see the breakout level of when gold, started to make this move higher. You see how the volatilities of the short, medium, long term all jumped up, and then they started getting higher and higher. And now there's been this retracement is underway in gold, and the volatility is all coming back down again, back to more in line with the levels that they've been before. So right now they're outside of their norm, the implied volatility levels. You'll find that the ranking is still quite high, and then you can see the short, medium, and long term. That's actually, I think, an interesting thing to look at when you're looking at these charts, is see what the difference is between your various terms of expiration. Because that gives you, you can see when the move starts happening. So back over here. I haven't done any real investigation into this, but you can see that some of the lower term implied volatilities now start to go up and overtake some of the longer term implied volatilities. So in a normal situation, they're kind of spread apart a certain amount, and then when there's something happening, the lines will start to cross. And if you do, you can actually write your own chart scripts here to detect things that are happening if you want, and give you an indication of. I think you can glean a lot of information you can't glean from just looking at a chart by looking at those implied volatility expiration numbers. That's something to, it's for further research for sure.
George, do the junior miners have options?
I beg your pardon?
Do the junior miners, or whatever you call them?
GDX, GDXJ?
No, the junior individual
Individual stocks?
Yeah. Very few of those.
Very few. Yeah, there's some of the bigger ones like.
Maybe Pan American does, or.
Yeah, Chris, can you look at a few stocks in the gold and silver space? So maybe you just start with something like PAS, Pan American.
Okay. Yeah, and they will have weekly options, do they?
They may. That's what we're.
Okay. Yeah, we'll have a look. Just before I say, I just wanted to point out one thing on the gold, and that is look at the number of how often the gold over the last year has been inside its expected move. That number, 68.25. That is bang on the one standard deviation. That is exactly what the models suggest.
Mm-hmm. So 68% of the time it's where it should be.
Yeah.
Yeah. So if that was lower.
If it was lower, then it means it spent more time outside of expectations.
Right. So PAS isn't got.
No.
Maybe try GOLD.
Oh wait, I forgot a new GT here.
Right.
Mana Gold, GDX, GDXJ, GLD, GOLD. That's Barrick Gold.
yeah, GLD spheric.
Okay, that's also at 68%. Looks very similar to GLD.
Right. It's a fairly large position in GLD, I think.
Well, Franco, Nevada.
Yeah. So again, you can see when gold started to move, you can see how it moved outside the expectation there.
Right here.
Do you have Franco, Nevada? We talked about that on Friday night with Barry. That's FNV. Chris, we've lost your audio again.
Sorry, can you hear me now? Can you hear me now? Can you hear me now? Hello?
Dan, can you?
1, 2, testing, check, 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 check.
You can hear me, but can you hear Chris?
Check. Hello, can anyone hear me? Check, 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 check.
Again, I don't know why. Like his chart stopped moving too, so.
Hello, hello, hello.
You're back.
Testing, testing.
Okay, we've got you.
Okay.
We were wondering if Franco, Nevada is in there.
It's not in there, no. I checked.
Not in there, okay. So there's not a lot of gold stocks that trade.
RGLD, Royal Gold, like these.
RGLD?
No.
Royal? No.
Wheaton, WPM.
Okay, Wheaton Precious Metals, WPM?
WPM.
Yeah.
Wheaton Precious Metals. There we go. All right. Yeah. So the chart looks very similar to the chart of gold, but it's the options. You know, this has only spent 57% of its time inside its expected move.
That's good.
If it's on the upper part, it's good.
Well,
It depends
on
what.
the lower part too. To me, that tells me either way. The guys who run the book on the options table will often.
There's another indicator that you can put on here. So this cone is always drawn with this layout. The cone's always drawn from the last bar, just kind of projecting out to the future.
Right.
But there is a expected move cone that you can actually just move around the chart. So if you find that in your chart scripts under EM cone days offset, just drag that over there. And then I'll set what you can do is then do something like just move it back in time. You'll see if you have a particular date that you want to see the cone for, then there's another chart for that. That's the expected move date. So let's take a look at that one. EM cone date. So say you wanted to see the expected move in a particular stock, and let's say from 2018 to 018/12/24. Okay, now that is that was the Christmas Eve last year, and that's what, taking all of those 12 different days to expirations for the options in Wheaton Precious Metals, this is what was forecast as expected for a one standard deviation move. Most of the time it's inside, but it has spent quite a period from July of this year.
So when the SPY started breaking out on Christmas Eve, did it stay within its expected?
All right, so Christmas Eve, SPY has been completely outside of its expected move pretty much the whole year. If you take the fixed date of Christmas Eve, it's exceeded expectations on the upside all year.
Right.
By how many standard deviations?
Probably 2.
Yeah, that'd be hard to say. This is the one standard deviation line, so.
Yeah.
Interesting stuff, yeah?
Mm-hmm. Yeah, and it's where you get that disparity between implied volatility and historical volatility that you're likely to make good money if you're trading, and I think that's what Dave McMullen was looking for.
Okay, so William wanted to look at XHB home builders and DHI. That's one of the home builders, right? So the XHB is your home builders ETF. That's right here. And
again, when I went to Italy and came back, the first thing I did was look at Minervini scan, and the home builders and the maritime shippers were doing really well. So I think I got back at the end of October the 10th or 15th. But I think home builders have done well this year if you started on the 24th again.
I'm sorry.
Christmas Eve, if you start on Christmas Eve, I think they've
Put a cone on there.
put your EM cone.
Yeah, and then change the date to Christmas Eve. 2018, 12, 24. Yeah, so pretty much outside for the whole year of all of the options as of on Christmas Eve. So what this means is that on Christmas Eve options were priced, but the expectation was it's going to be inside this cone along the way, and it's just spent the whole time outside of that cone on the upside.
Okay, so Chris, from a conceptual point of view, it spent its whole time outside the cone, sometimes reaching back towards the red line. Like, yeah, right there, further to the right, a little more, whoop, right there.
Right there.
No, back there,
That's
yeah.
it.
Would that mean that you'd be losing money? You should have sold before at the widest spread above the red. Is that correct?
No, well,
It's sort of like moving averages. Like if you're a longer way away from moving averages, you get a reversion.
Yeah. But
Right.
I'm just looking at you had the lead.
Mm-hmm.
The further you are away, either proportionately or in dollars, and I don't know what, but I would expect that would be your, if you had sold at that point, that would have been your maximum gain, because the stock is actually losing money and coming back towards the red line.
Yeah, I don't think it loses money, but it does come back. So you do have a correction.
but
So yeah, you lose some of your profit, and then it takes off again.
Yeah. Okay. That's.
So
But also that depends on what options you're buying. You know, what length of how long a period of time you bought the option for.
Absolutely.
like if you bought some leaps here, on XHB, the home builders, and then I mean basically that's what Dave McMullen would do. So on the 24th, you can buy a leap, and then you wind up selling premium against it. So that's one of his favorite option strategies is to buy a leap on something that, but I mean, you don't know at the time that the home builders are going to do well, but at the time, you may have thought the market was going to do well, so you could have bought a leap on the SPY and then sold premium against it.
Right. The best money you could have made here, I believe, is going to be if you bought on the 24th a very short term to expiration, so maybe you bought a 15 days to expiration option. You bought it on the 24th and you sold it 15 days later. That was a straight up move. That probably makes you a better percentage than buying a leap and holding it until over here.
Yeah, you're going to get a better percentage move just by 10 days out on the 24th.
Yeah. But of course, you also have a very good chance that that move is not going to happen. And if you only have a 10 days in your options, you're not giving yourself, there's a good chance you're going to lose 100%. But if you bought specifically an option of 10 days to expiration at that point on December 24th, you have a potential of making maybe 2,000% on there.
Do you know how many times I've bought in things when I thought the market was capitulating, and like I think that was one of the things that happened with my Priceline trade where I made $200,000 over 200,000. But I bought that at a market bottom.
Yeah.
And the interesting thing was not only was I buying, Jeff Scott also was buying, And I think John Person was also buying. So we were just looking at the capitulation move, but it was, again, to green candle low at the lower Bollinger Bands where we thought there was pretty limited risk. And so when you had that red candle outside the area there and then you got it negated by the next bar, when it negated the next bar, that to me was a fairly low risk entry because your risk is to the bottom of that other bar. No, you come down lower still.
Sorry, whereabouts?
So your December 24th, I think you've got, is
Yeah.
that a red candle?
That is a red candle, yeah.
Okay, so you put a buy stop in above that.
Yeah.
And so your risk now is from the bottom, from the top of that candle to below the lows there. You swing low. That's
Yep.
what you're risking. And then it takes off up across the bands there.
Yeah.
Again, if you had Bollinger Bands, you're probably in bucket -1 or something or other.
Right.
You're in negative buckets, and it just goes across the buckets there.
Yeah. If you're wondering why the cone doesn't look very smooth at this level, just remember that there are holidays in here, the weekends and holidays. So if this was drawn, if the chart was showing just actual days instead of just trading days, this would look more smooth. William wants to look at DHI to give a comparison. So
that's one of the home builders.
Yeah.
So it's D.H. Horton.
Yeah, so let's just go to DHI. And does that help?
Paying attention. Right. And DHI came out when I was looking on my Minervini scan. So again, if you put on, like if you had a 50, a 150, and a 200, you would have seen all of them were rising when it came back in beginning of October. And so I think DHI was one of the stocks that came up on the scan.
Yep.
Not that I know of. I don't think they. Right. No, I don't think we have any of the Lennars or D.H. Horton or KBH Homes or KB Homes.
Yes, that's a shortage.
So William had a couple of other questions. Just want to get through. Can the expected move percentage be adjusted? So I think you might be talking about, we're talking about the expected move is your one standard deviation, your 68%. So that's fixed. That's what the expected move line is showing you, or the cone.
So Chris, instead of your seasonality, can you put your linear regression channel in there and just see what of the weeklies are having the best percentage returns?
Do a template, do the scan for linear regression?
Sure.
Is that what you, yeah, okay.
And that's on your weeklies, yeah.
Okay, so now we're looking at linear regression, and that was instead of seasonality. We'll put that down here. Just doesn't matter where it is really, but and then looking at the weekly performance or longer?
Look at a little further out, maybe 1 month, just annualized growth rates.
All right. Yeah, so we've got SYNA. I'll take off this cone, that's just confusing right now. Right. Yeah, so that's got a 424% annualized growth rate. It is way outside of the 30-day expected move.
And again, when it went outside there, that looks like where you start getting some interest. So, you know, if you'd bought that somewhere around 48 plus a little bit, really now 60, that might have been a good entry point. Imagine you're going to get the same with CRSP because I know it's had a nice move as well.
Yep.
So again, it goes outside. You've got resistance there. When it breaks resistance, that's somewhere around 53, let's say. Goes from 53 up to 65. So again, that had a nice move. AMRN, again, we're looking at these in hindsight, but again, you're looking for commonalities where they go outside. So it's not currently outside. And when it did go outside, it didn't continue. So PCG.
So that's interesting because it says it's up over the last, it says it's on a very steep slope. Well, I guess it's a low price stock, so these moves are.
Yeah, they're going bankrupt. It is now,
Yeah, that's PG&E. That's your California fire
Oh yeah.
company.
Pacific Gas and Electric. Yeah.
Teva Pharmaceuticals.
Okay, so again, this week when we're looking at things that we're moving, generic drugs was high on the list. And again, you can see it went outside. If you'd had a buy stop in there when it went outside, somewhere just over $9, and it's currently just under 10.33.
Yeah, that could be a good scan. Is you know, stocks that are currently outside their expected move, and then you can.
Yeah, well, I mean, basically they're breaking above a previous resistance level. So.
Yeah, and probably if you're looking at, it's probably significant because people who are holding the options at that point that it goes outside of the expected move, they've, you know, probably there's something has to be done to adjust their position. So that, you know, may be significant.
Plug, I think, has had a good move. Next one down. So again, it looks like it went out just below $3, and it's currently at $3.38.
Kind of 5G, say.
Play on 5G.
Not sure. Puma Biotech.
Puma Biotech. So again,
Stayed within.
Been moving steady, but not outside above.
No, but it came from below to inside, and now it's, you know, inside.
Right.
Tenet.
Tenet Healthcare, yeah. Again, your buy is around, what, 27?
Yeah.
Change. And it's currently 31. 27 to 31. It's over 10% move.
William, the cone percent is asking if the cone percent can be adjusted. So no, the cone is a fixed cone, so it's just showing you the 68% level. You would have to just, you know, take that in mind that that's 68%, one standard deviation. The template does show IV percentile, yes. The template is right here, and we've got the volatility, IV30, that's your actual number, but the percentile is the rank. So rank, you can think of rank as being percentile.
Never made it out.
Is a good one. GE, everybody thought. So what was the story with GE in the end? There was this big news thing that the Somebody said the accounting was terrible and that they were going to be bankrupt in a short period of time back over here, and then now it's just over 11.
Right. So again, you get in around 5 if you use that.
Yep. It's definitely something worthwhile to point you at things that are outside of their expected moves. I think that's a pretty good idea for a scan.
Yeah, because when you're doing something unexpected, unusual, abnormal, those are the things that you make money on, right?
Mm-hmm. And I guess if you just go down through this list, if you're just doing a visual check, you can just go down through here and see if it's just poking its head outside of the expected move.
Mm-hmm.
And William says, does the rank compare one stock against all the other stocks? No, the rank is compared against itself over a 1-year period. Actually, various periods. 1 year is the first one, but it compares over 6 months, 3 months, 1 month as well.
Okay, you got AMD coming up. That's it's had a pretty nice run, and again, Jason Leavitt's got that analysis that he has there. So again, when it went out, you were in somewhere around 35. Whatever. Yep. Okay, and it's currently 39, but you probably would have gotten out somewhere earlier, somewhere around 40 or so. Hopefully. Okay, so it went from 35 to 40.
Yep.
It's just peeking its head out. So
there you go. Yeah.
I stop there. Again,
that's one.
Expensive stock. You may also want to do this with option. So buy a call on it and see what happens. Actually, that's something do all of you have a paper money account? Okay. So yeah, so if you have a Thinkorswim paper money account, Chris, have you got the high there for Friday for SRPT?
Yeah, let's put that on here. 107.51.
Okay, so you're going to buy some SRP 110 calls if SRPT is at or above 107.52. Do it in your paper account. Just see what happens. I think it would be interesting to. And again, if you just do one trade, maybe nothing much happens, but this looks like a nice setup. Chris is putting it in on his favorites. They're $2.39 as of the close, yeah. 107.52. 107.51. Okay, perfect. Make a note, see what happens. Good.
Sorry, yeah, back to SRPT, yep. Well, William, did you read William's? Okay, here's another one that's just coming outside of expected move, TTD.
Yeah, okay, so we can put a buy stop above that little wick there.
Yeah, that wick there.
So the high there, this is TTD.
TTD 245.96.
245.96. So that's 245.97. So again, probably by the 250 calls, if at or above 245.97, you may want to go a little ways out because it looks like they last for about 2 weeks or so.
Yep, an implied volatility rank in TTD is 1, so very low. And it's in bucket number 10, so it's just outside of its upper Bollinger Bands.
And again, Tyler talked about constructive swing patterns. You can see, I imagine that's an action bar, that big long one. And so it looks like Yeah, so it looks like you've also had a trend line, declining trend line. So if you put a line above the tops there,
Here?
no, just the other, then further along, just before you got that big bar. So just
Sort of down here.
in there, yeah. It's going to be a very small one.
And it'll probably move up to resistance.
So that this was a better entry there. Okay, anyway, you had an entry there off of that falling channel. And like you said, those have been doing better than breakouts above resistance, although you do have a break above a resistance there.
Mm-hmm.
So again, those are good. Swing high breakouts.
William wants to look at ALGN. And this is, by the way, this is all available in the trial version too. So encourage, if you don't have the software, encourage you to download the trial and play around with this.
Okay, so again, when it poked its heads above there, you would, nope, further back, about 8 bars back.
Oh yeah, here, yeah.
Right there. So the high there was?
Approximately 207.46.
207.46. Now I don't know if that's an earnings gap. It probably is. So the question is whether you're prepared to hold over earnings.
Looks like earnings was here because the implied volatility numbers are really high here.
Really high, yeah.
Yeah.
Anyway, it has a nice move after it moves up there after earnings.
Yep.
And then if you don't hold over earnings but get out before, you probably have done reasonably well on options that you bought. And then when it gaps up, again, if you're watching it, it looks like it goes from about 240 up to the price now, which is what, 274.40?
Yep.
We just had a mobile breakout.
Okay, so you've had a nice move there. Actually, I'll look at the options on that when I do some work on Thinkorswim here.
This one quarter they improved. The previous quarter dropped there.
What's that?
The previous quarter had a big drop on there.
Yeah, it had a big drop before, but this one looks much more promising, right?
Yeah.
And it looks like it almost looks like somebody knew something before earnings because it started to move before earnings. And Tyler was talking about that, the way he got into trading stocks was by doing insider trading analysis at university.
Oh, yeah.
Yeah, Netflix just poked above the expected
Okay,
move.
that's interesting. Netflix is popping up. So again, there's another options trade for you. I don't know if it has earnings coming up. What's the high of that bar, Chris, where it first poked its head out there?
The high there is
312.70.
312.69, yeah.
Okay.
Had earnings already, looks like. Right?
It's had earnings already. Okay, so we're going to, yeah, so we're going to buy the 315 calls. If not, a lot of you may not know how to enter that on Thinkorswim, so I'll show you that when we're doing the Thinkorswim bit. What's that? Yeah, so yeah, I usually do a 1 penny above, but if it's above 312.69, it gives you the same thing. Again, you had that sorted by annualized growth for
I had it by the 30 period annualized growth,
right.
or yeah, the 1 month.
Right. So how far did we get down that list there?
We were just looking at.
We were looking at a line ALGN, I think, or maybe somebody. We looked at GE. We looked at maybe LABU. I wouldn't trade LABU. It's a leveraged. I'd trade LABU, but not the options on it.
Okay. Did we look at AMD?
We did look at AMD. Yeah, it moved out and it had a nice move up there.
ABU, ICPT, Intercept.
Yep. Now this is another one. Jeff got me a lot of money on Intercept when it broke out. Another time, like he was able to buy a yacht with the money he made off of it. Intercept. Intercept. Okay, I'll just tell you in advance. It has wide spreads on both the stock and the options. So I just asked him. He just said he just held his nose and hit the buy trigger. So, but again, it's had a decent move. I think the first time it moved out, Chris, was where there's a little doji eye just before that long candle move.
Just here.
Right there.
Yeah, and just before there, it did move out.
Okay. Maybe the other candle too. Anyway, just put your cursor there. So that was around 77, say 77.11, and it's currently 88. Okay, so again, it's interesting when you start looking at things how you can develop a sense of a trading system just by. I mean, what are we really looking at here? We're looking at unusual moves, okay? These are things that are above and beyond what the expectation has been. When you get unusual moves, that's where you'll find profitability because nobody else was expecting this.
And if you can find something that's you know, gone outside the expected move, but also has low IV rank,
IV numbers, yeah.
then you'd be good buying a call.
Mm-hmm. Okay, TA, we'll go down to the 200 percenters, just a few more, just see if we've got any other. Okay, there's one that moved a few days ago. So again, it was about 122 at the top there, and it's currently 127. But again, I'm sure if you'd bought options on that, if the option spreads are good, you're up. Let's move $5, you're going to be up a bit. CTL, where does it move up? Okay, so the only problem here is you can see it gaps down. So you buy in, it gaps down, goes against you, you probably lose money there. But if you're back in again, yeah, it's around just under $14, and it's currently $14.97. So you probably got stopped on that, unfortunate. Cirrus Logic, ooh, be nice if you could do that intraday. Somewhere around 65, it's currently 69, right?
Is this an earnings thing, right?
That's probably an earnings thing, yeah. Now again, a big move.
Like these down below or just.
And again, I'm sure if you've got your EdgeRater and it gaps up in the morning and you get in the first few, you're looking at it on Chris's chart. It's telling you that this is a good opportunity to buy. So you can probably do that on a shorter term. And you can update EdgeRater, right?
Yeah, you can hook it up to Thinkorswim and it will update.
So give you the thing
real time. Yeah.
Yeah. So again, if you can do a scan on that earlier, that'd be even better, right?
Yeah.
So we're looking for things that are outside the expectation levels. Continue on. CYPR. again, your little nose picked out there about 116? Not that far.
Eight.
Go back 2.
Oh yeah, here we are.
Right there, I think that's where it pokes out.
Yeah, that's about 116.85.
And it's currently 121.
Yeah.
Okay, so Chris has developed a trading system here just using expectation of the options premium. That's kind of cool. I always love those kind of discoveries. Humana?
Well, I mean, I did not develop this trading system. But
Oh,
George has just developed a trading system based
No,
on the.
you just developed it, Chris. Just
I
somebody's
think
paying attention, but you developed it. It's
I think you developed the
your
system.
baby. No. Okay. But it is looking good, don't you think? What we're looking now, again, we're looking at some exceptional ones here because they have very high annualized growth rates. Okay, continue on. Humana. Oh, that would be. Oh, that's pretty nice. So 292 or something like that. Your entry.
Yeah,
Come back
probably down here. Yeah,
right there. Yeah.
292.60-ish, 67.
290. Yeah, and it's currently 338. Okay, I'm gonna look at those options as well. Okay.
But the better entry is where it hit the bottom part there, where it broke out.
Well, it does come across the bands, but again, you know, you probably have a channel there, a descending channel where it starts breaking up, but you'd be looking for a volume signature or something like that.
It's right into
But
resistance.
you know, it's staying within expectations. It's when it's not where it's expected to be that I think it's worth trading it. So you're trading in the fat tails, not in the
Mm-hmm.
And it's gonna,
Once-
if it goes to 353, it'll be breaking out to new highs.
Mm-hmm. I'll look at fit.
It's not being bought out, isn't it?
Yeah, Google.
Oh yeah, right. Fit's being bought out,
Picking up my medical data.
right?
Pisses me off.
BHC.
It's all on the bit there. Blood pressure, heart rate.
Okay, that's at 25, currently at 27.58.
Yeah.
Okay. Had a nice move. Disney, I know, moved up on their streaming services.
There.
Yeah, so again, you've got a huge bar. You'd hope you'd find that earlier. Again, it's not easy trading when you get these huge wide range bars. But I remember looking at this. Was it you that told me about Disney?
Yes.
Okay, so on the same day that Disney was doing that, what other stock was moving that's involved in streaming?
Roku?
Roku. So if you look at Roku, Roku had a very similar breakout, but didn't go above expectations there. But you can see how Roku moved. And that was a really nice move in Roku. Okay, let's go back where we were. Can.
Had already explained Disney? Is that?
No, they just announced that they had million subscribers to some, I don't know, a huge number of subscribers.
Yeah, 10 million.
10 million that they signed up in the past week. Yeah. And then the naysayers came in and said, well, they signed them up, but most of them were not sticking around, not prepared to pay. There's some ridiculous deal or something that got them in there. Edit.
Yep.
Chris, are you still there?
I'm still here, yep. Can you hear me now? Can you hear me? Check.
Chris, can you look at edit?
I am looking at edit. Apparently my computer is not broadcasting that.
Right, you're ahead of your screen. Screen can't keep up. Okay.
Can you hear me?
Yeah, so
Okay.
it's just broken out. Again, a big long wick there. You can use the lowest high there if you want to trade something like that. So the lowest high would be the green bar, and that's where you would have gotten in.
Okay.
Hewlett Packard, HPQ. Okay, that's not what you want to see. You don't want to see a gap. That's what does Gil call that? That's an SGU. That's a sellable gap up, right? CVS. Okay, so it poked its head out somewhere in there. Yeah. So that was around 67.50, and it's currently 75. So it's up about $8, 15% or so. NKTR, I think that'll be the last. Oh, maybe we'll do one more there. Red bar poked out, gapped up. Now it is showing up again. So again, you could maybe just want to trade the stock on this. Chris, what's the high of NKTR there?
The high is 21.22.
Okay, so 21.23. Okay, so again on your paper account, if it gets above 21, at or above 21.23, you're going to buy the stock. Last one, there's Signet there. I think CI. Cigna.
Yep.
It's gone. Oh, that's had a nice run. So that was around 176, and it's currently 201. Okay, so we'll look at those options as well. And then last one I wanted to look at was Regeneron, REGN.
Mm-hmm.
AMTD, yeah. Ameritrade, it could, I think it might be, yeah. You want to look at that? Okay, so again on these, when you get a big bar and then you get smaller bars, you go for the lowest high, not the higher high. So I would enter on red bar denied or red bar ignored, as Oliver Velez would say. So that would have been around 334 and it's currently 360. I can show you that one. We'll look at that. Show you how the options behave. There's a few others in there I've traded, so let's just look at that. Baidu, could you check Baidu, Chris?
Yep.
Okay, so again, it poked its head up. You put a buy stop in, you got filled, and then it's deteriorated, so you're out. So you would have lost on that one.
It's just poking above now again, or it's just at. But in the next few days, it's worth watching.
Yeah, so it's worth watching. So you can put Baidu on your watch list. And seasonally, I think it might be okay. We'll take a look at that too. And Ameritrade, let's try.
Sorry, I have the seasonal template right here. So that seasonally, it's not nothing in the next 1 week. Nothing to speak of here.
Okay.
Yeah.
It used to have decent seasonality earlier in the year.
Mm-hmm.
Oh, okay. Yeah, it gapped up. So that was an SGU again.
That's the buyout.
Oh, it's being bought by Schwab, isn't it? Yeah. Right. Okay, so it's just acquisition. Okay. Oh, and there's the stock that paid for my best choice software. It's Autodesk, ADSK. It was, anyway, I bought it when it was, I can't believe I didn't hold on to it. I bought it for $34 and I sold it for, I think, $80. That was a long time ago. Anyway, it was in a very nice uptrend. high annualized growth rate. It was before 2009, so Chris would have to go back a long way to find it. He's going to try too. I can.
No.
No. Okay. Anyway, we've got lots of material there. I think Dave McMullen's been using this very successfully, and once I can download some data for my EdgeRater, I'm getting my computers fixed up right now, and
Good.
once that happens, hopefully I'll be able to do this. But that looks like a nice move there from once, whatever. Okay,
Yep.
So do you have any questions for Chris about options? These options is implied volatility, historical volatility columns, and template.
Who thinks they're going to use it?
How many of you trade options? Dan definitely, and Brock, Gary, Lawrence, you trade options.
Yes.
Do you have EdgeRater?
No.
Have you gotten a trial?
I do now. Good.
Okay, so you just use the trial, make a bundle of money, and then buy EdgeRater. Casey, you don't have EdgeRater. Do you trade options, Casey?
Well, I was thinking about it with the price heavily. I haven't.
Okay.
I'm
Cool.
until I get that money raised for in-house.
Okay, so you're working on. Okay, well, thank you, Chris.
Yeah, you're welcome.